So let's start diving into some live trading examples, having our primary focus on the execution process of each individual trade. Now, it is very important that you pay close attention because I will be talking about advanced details which are really situational dependent. Okay, so pay close attention because I will be talking about certain advanced tiny details that you can make from an overall execution process and things that we've talked about to get those even better entries and expectations. So this trade should already be a familiar one because we have talked about ETH Model 1 distribution schematic back in the end of April within section B talking about these high probability variables. Now, as you can see, this was the follow through from that ETH trade. And you can see that we actually did not end up hitting the technical target of the range low, where from a fresh reminder, right here, we had that lower time frame breaker structure where I was elaborating on the fact that this push up right here, okay, that push up was seen as manipulation, and therefore we could still simply use this high quality breaker structure that is closing back inside the original range value, which is below this second tap high if we make that adjustment. Now, that is also going to be very important for you to understand that when we get that high quality return to zone and we get that final pop-up effect where I am expecting manipulation, then if we have a higher time frame market structure low deeper inside of the range right here, but I am expecting that demand to not deliver anything because the purpose of the push up was to mitigate that third tap POY, which adds conviction if you actually have a proper third tap POY for price to tap into as the third tap. I'm obviously not going to be waiting for this market structure low, despite it still being the higher time frame market structure low backed by some sort of a structure demand POY. As you can see right here on the 15-minute time frame, that is your 15-minute market structure low backed by a structure demand POY. However, I am expecting that move up to be manipulation. Over time, you will get a better feeling for this, but a tip that I can already give you, if you have a high quality return to zone, within the total range, which we have right here, and you get that final pop-up where the timing is around a session open, in this case, your Asia open pushed price up. This pop-up started exactly when the Asia open started as well. You are very vulnerable for this push up to be manipulation, especially if you have a high quality resistance POY right above that second top high. So we had that high quality resistance POY, we had that quality return to zone, and then we got that final pop-up exactly on our Asia open. That's why I'm expecting that push up to be manipulation. And as long as we get that quality breaker structure, I'm still looking to short it because this demand is not going to be protected via market makers because the purpose of the move up was to mitigate that supply to then sell off aggressively, delivering that buy to sell. Just as a tip from an overall contextual perspective when trying to look for that correct market structure low. Because at the same time, you can see right here, if we go to a lower time frame where that breaker structure was indeed valid, right here, you can just see how aggressive we are immediately breaking back inside that range with that quality breaker structure, also closing deeper afterwards immediately in that supply, already showcasing the weakness of the demand itself. So based on my expectations of this demand being just fake demand to create that push up, this is going to be our entry exactly on that breaker structure. Now, what you can see right here is that the price did not end up hitting the technical target. So let's see how you could have managed this position. So in the process right here of price coming down, you don't change anything about your setup. Stop loss remains the same and your take profit target remains the same. Because of that aggressive breaker structure, we have created a supply POY in the exact pivot point where that third tab was created, which you can see right there as 5-minute structure supply, which probably on a higher time frame is also a valid order block. Right there as a 50-minute block, it is also represented. So this 15-minute block is going to be your extreme supply, which is obviously a very high probability extreme supply POI because it's located in the third tab of your Model 1 distribution. And price is therefore allowed to pull back into the extreme supply POI to create a potential extended distribution model before coming to the technical target. As you can see, price pulls back after breaking structure back into that extreme supply POI and gets a rejection back down. Now, if you missed an entry, are you going to be limiting in on that extreme supply POI? No, because price took a long time before retracing back into it, already having its own rangy price behavior in here. If price created an aggressive break of structure in here and what followed afterwards was an immediate retrace, that's when you can actually start limiting in, because the only reason you did not enter on that break is because the break was too aggressive and just unsure. So then the moment you get that deeper break, already showcasing the failure of the demand, in case that was bothering you since you were not understanding the manipulation part, if something like this develop, that's when you can actually place a limit order if there's no level 2 break of structure reconfirmation opportunity for you to watch. But in this case, price took its time retracing back into it, and therefore this is also way more vulnerable of being just an overall extended distribution model, where then that tab is just a Model 1 flowing over in a Model 2, which only gets confirmed the moment you break structure. But right here, on the 5-minute, that is going to be our break of structure confirmation and our entry, okay? The entry being at 1,834.36. The moment price taps into our extreme supply and breaks structure back inside the range, where right here, we're SFPing that market structure low before breaking it back to bearish, right there. That confirms this as your extended tap, because you got your bearish break of structure. And therefore, this is now becoming part of your Wyckoff model, because that break of structure confirms this Model 1 going over in an extended distribution model, where the Model 1 is flowing over in a Model 2. And then this becomes your fourth tap, or on a higher time frame in this situation, a 3 tap from a Model 2 distribution perspective. Therefore, you can now trill your stop loss that was initially above that third tap high towards the fourth tap high right there, where you can see that us trailing the stop loss is also obviously in the extreme premium section of the overall range. But if you were initially risking $100 on a 1.24% stop loss, and you can now trill the stop loss down to 0.5, your $100 risk gets diminished to around a $50 risk. So you're already de-risking half the position simply by trailing the stop loss while keeping the profits the same. Now from there, price rotates back down towards the extreme opposing liquidity, where you can see that that is that first higher time frame, higher low, the most obvious higher time frame, higher low within the range that price retraces back into, and therefore we are sweeping right here the opposing extreme liquidity. You then need to ask yourself, when you see an aggressive sell-off towards the opposing extreme liquidity, where in the process of going down, you are creating supply, protecting price from coming to your new invalidation, do you want to see price rotate all the way back up to this high? Of course not. Or even above this high? Of course not. Because this right now is the extreme supply. Because above this high, there is nothing but liquidity. 1 high, 2 high, 3 high, 4 high, 5 high, 6 high, this is where you saw that redistribution effect creating the supply, and right here we are sweeping opposing extreme liquidity. So I do not want to see price reverse back up and break above this supply POI, because above that supply there is nothing protecting price from coming to this market structure, or from to this high right there, which is our invalidation. So if there's nothing above this high that's protecting price from coming to our invalidation, then that becomes our new invalidation. And we can trill the stop loss above that high, while at the same time, we are sweeping opposing extreme liquidity. So even if there was a supply POI right there, I wouldn't want to see price reverse all the way back up from also a preference standpoint. So then obviously if our entry is from here, and we trill the stop loss to here, our stop loss is going to be in profit. Where this stop loss right now gets trilled above that high. So despite price V-shape reversing back up, we're getting stopped out in profits. So while we are wrong regarding our initial idea, we are still making money. Okay? And that is so crucial to understand, that we can be wrong and we can still make money. Trill that stop loss to that new high right there, because that is your new extreme supply, while price sweeps the opposing extreme liquidity. Therefore, we don't want to see price reverse back up. And then this trade gets stopped out for a profit right there, which is also exactly how we manage the position. Now, if you had conviction in this trade, you can also trill the stop loss and add the risk back right there. And then even if you did that, you would still gotten out or gotten stopped out in profits, because this stop loss placement is below your entry when you are short. So we have the initial entry right there, where we are entering on the break back below that second tap, where we are ignoring this demand because we're looking at it from a manipulation perspective. Then price takes its time coming back towards the extreme point. Therefore, you cannot limit in if you did not have an entry on the breaker structure, and you wait for a reconfirmation. You get the reconfirmation, you trill the stop loss to that new high, because there's no supply protecting price above this high from coming to your original stop loss placement. And then price rotates back down, sweeps the opposing extreme liquidity, creating extreme supply in the process, and we trill the stop loss towards that extreme supply into profits, because after sweeping opposing extreme liquidity, we don't want to see price reverse back up. If this supply was created at a point where I would still be risking money, I would just put my stop loss to break even, because I don't want to see price reverse. If the stop loss is really in the middle of the supply POI, I will take a partial take profit to keep my stop loss above that new trilled high, to the point where I'm also in a risk-free position. Okay, very important to understand. Now, moving on to the next, it's going to be TRX, which is going to be a similar situation as ETH. So right here, I traded this a Model 2 distribution schematic. We have a beautiful range creation with our tap 1, our tap 2, and a very high quality third tap POI right here, where we can see we had the obvious lower high for the lower low, where this right here on a lower time frame was also a structure supply POY. Right there. You can see on a lower time frame, beautiful structure supply POY overlapping that tap 1 with that lower high front running the supply POY, creating that lower high buy side liquidity that price can sweep coming into the level. Now, besides that, we're meeting all the high probability variables, where the range duration is getting met right here. So from tab 1 to tab 3, we have 15 days. We have a high quality return to zone right there. And we also have a high quality third tab POI. The only thing that we need to watch for is a quality breaker structure and then some proper trade management. Zooming in right here, for which market structure low we need to use for our TCT distribution confirmation, we are in a similar situation as we are on ETH. Okay? Similar situation as we are on ETH, where price right here is tapping into the third tap. And mind you, this is such a high probability model where I just need to see something to confirm the setup, which is a quality aggressive break from the POY that we pre-planned. If I'm on the 15-minute time frame, you can see right here that we have a low, we have a high, and we have a higher low for a higher high on the 15-minute time frame, where this is going to be our 15-minute market structure low, where that 15-minute market structure low is backed by this structure demand POY right here. If we zoom in to a lower time frame right here, we can see that we also have a 5-minute market structure low, which is located right above that structure demand POY of our 15-minute market structure low. So with the initial information provided to you, you would assume, hey, let's wait for this 15-minute market structure low to be broken back to bearish. However, I was looking at this demand POY from a manipulative perspective. Why? If we turn on the session indicator, you can see that the moment our Asia opens, we get the sell, we get the buy, and we create that demand right on our Asia open. Again, right on our session open, where we then reverse back up into that supply and get an aggressive breaker structure after a nice local Model 2 distribution right there, which we're not going to be trading, but it's nice topping formation backing up the break. And then the break right there is super aggressive. So this sell to buy exactly again on the opening of our session, while we're tapping into that high quality third tap POY, if I see that quality breaker structure right there, I'm looking at it from a manipulative perspective, because we got that quality return to zone up until that point, and the sell to buy was created exactly on the session open, tapping into our resistance. If this was not on the session open, there is still a way to trade this from a more refined perspective. If this was just regular timing and not around any particular New York, Asia, or London open, just in the middle of a session, when you get that bearish breaker structure, you do not enter yet. Okay? Because you got demand, and that low time frame breaker structure can deliver a higher time frame, higher low following the 50-minute market structure pool. What you will see is that price is retracing deeper in the demand. You guys should know that if you have a structure demand POY, which has that inefficiency, but on the lower time frame, there is nothing but the liquidity inside of this block, where here on the lower time frame, there is nothing in this block itself from a refined perspective. It's just lows getting built up here. You preferably want to see a tap and go, meaning you tap the demand and you go, in case of a fake break to mitigate demand to go higher. So you know that if we're going to be bouncing off this structure demand, it should be a tap and go. So we tap it right here, and then we start to bounce right there. We tap it, go a bit deeper, and we start to bounce. Now the question is, are you going to get your 5-minute lower high for the lower low in this created structure supply, or are you going to get the 15-minute higher low for the higher high? And that is when you simply go on a lower time frame and you either watch for a level 2 break of structure, where you're identifying the structure from low to high, or you're simply waiting for an aggressive rejection. So if we get a local push up in here, making higher lows and higher highs, and we break that back to bearish, that is going to confirm the lower high for the lower low following that 5-minute market structure pool, combining level 1 and level 2 structure. And you know that this demand should be a tap and go. So when you tap it, but you don't go because you confirm a bearish break, you're going to slice through this demand because there's nothing other than liquidity on the lower time frame. Where if you don't get that level 2 break of structure, but you just start rejecting aggressively deeper into this demand, that is also a representation of your tap and go failing because you're not tapping and going. You're reversing back down. So the moment you see this aggressive close right there, that is indicating that this tap and go is already failing because price reversed. That is where you go short. If this wasn't created on a session open, keeping the stop loss above that third tap high right there. But you don't have to wait for this break of structure because you're expecting price to reverse back down to this low in general because there's nothing to hold price up to protect that low because the demand that should deliver a bounce didn't. So you can already enter on the failure of the demand, which gets confirmed the moment you break deeper into a tap and go POY. So right there, that showcases the demand failure. You enter already right there. If this wasn't demand created on an Asia open, otherwise you enter on the 5-minute break of structure already right here, while keeping the stop loss above that third tap high, targeting the range low. For a 1 to 8.2 risk to reward. Now, what we're going to do from there is let your trade play out, because then you're simply setting and forgetting, and you need to give the model some time. Now, right here, we can see price immediately delivering a retest for a lower high for a lower low. This could be your LPSY. This could be your extended tap, your fourth tap from a distribution perspective. But let's see if it also actually tapped into extreme supply, because around our entry here, we created two supply POIs. Where right here on the lower high for the lower low, we created supply, but the lower high for the lower low front ran this supply POI that happened on the actual break of structure, confirming the model. So can we trill the stop loss? Can we trill the stop loss from our third tap high to the retest high? No, because there is extreme supply above that high. So price does technically have a reason to go back above that high before going lower. So we cannot trill the stop loss because it did not mitigate extreme supply, because extreme supply is the upper block in here. That is your extreme supply. So because we did not mitigate the extreme supply, we can't also trail our stop loss. Okay? As tempting as it may look at that moment in time, when you're delivering the lower high for the lower low, we need to keep the stop loss in the exact same spot. However, from there, price sweeps the opposing extreme liquidity. While on the way down, we are yet again creating structure supply right there. Because price already got the rotation back down, sweeping opposing extreme liquidity, do I want to see price reverse all the way back up above this high to mitigate the extreme supply? No. Because when we are entering, the conviction is having that sell side liquidity below. So when we sweep the opposing extreme liquidity and we go back up, we don't have that liquidity target below us anymore because it already got taken out. So the moment that price is sweeping that opposing extreme liquidity, I don't want to be risk on anymore. So despite price still having an extreme supply POI above, I am trailing my stop loss above this obvious created structure supply POI within our range. Because I'm expecting if price closes above there, we're just going to invalidate the entire model because we already got the move down, sweeping opposing extreme liquidity. So it's more from a preference standpoint. Now, from there, we can see that price ended up, I believe, retracing back into it. Lots of ranges, retracing back into it, dumping before absolutely reversing. So right there, we mitigated the extreme supply and we started rejecting, breaking structure back to bearish. My apologies. We did not mitigate extreme supply, but we mitigated the supply that we wanted to see, deliver a rejection for us to hit our technical target, because on the way up, we created nothing but sell side liquidity. So it should be an easy move down. So the moment we mitigate a supply POI where we wanted to see a rejection and we start rejecting, we can trail our stop loss towards that rejection high. Why? Because if price comes back above this high, it should be a free rotation back up to that high. And because price already swept the opposing extreme liquidity, if we grab that high, I'm expecting the entire model to fail. And our average entry is at 0.27753 if we had the worst entry. Therefore, if our stop loss is at 0.275, we are getting stopped out in profit and we are actually making money when our initial idea was wrong. So I hope you are starting to get the point. Where it's despite this not tapping into extreme supply because we already swept opposing extreme liquidity, I do not want to see price reverse. Because the model basically already completed itself, but it just front ran RTP, which sometimes happens, right? It sometimes happens. Now, next situation is going to be CRV. And right here on CRV, we have our Model 1 distribution schematic, okay? Again, a high probability Model 1 distribution where the range itself meets the duration, 3 minimum days right there, which is well above that 1 minimum day in duration. Model 1 distribution, so easy quality third tap POI, got to return to zone, and then we're about to get and go into that breaker structure and the overall execution process. So what I'm seeing right here, if I'm just looking at this range as a whole, is that we have a nice return to zone kind of up until this point. This is kind of where price divides the overall return to zone in some like two partials, where right here you can see your primary higher lows building up right there with also local higher lows right there and these lows. So all these primary lows right here are building up, building up, building up, building up, building up, and building up, with also some internal lows right there in the process and right there as well. And then we kind of have a more aggressive expansion into that third tap, okay? Bit of a more aggressive expansion into that third tap. Now, you can see here that on a lower time frame, you have some sort of a structure demand creation, where the upper section of this structure demand right there got overlapped with that lower time frame block, which is definitely, you know, a nice demand POI. Right there, you can see that this total structure demand at that high got overlapped with this lower time frame structure demand POI, which is also an order block. And therefore, this is where that true inefficiency is located, where this represents the buying pressure of the total block while showcasing where the true inefficiency actually is. So we do have a demand POI right there that could make price bounce, okay? That could make price bounce. Now, despite that, we do have some lower time frame liquidity lows below that, and we also have just highs above that. Now, the moment we tap into that third tap right there, we simply need to wait for a break of structure confirmation, where right here, on a lower time frame, we have this 1 minute market structure low. Now, this 1 minute market structure low is also back below that second tap high and is therefore valid to use from a market structure low perspective. We just have to be aware, is there demand underneath that low that could protect price from breaking higher time frame structure? Now, in this situation, you did actually have a 15-minute higher low that was backed by a 15-minute OBIF. Where right here, we have the 15-minute OBIF, but at the same time, we also have this demand POY below it. So you do have some support levels below that could cause a reaction of price from the upside perspective. So despite price right here getting a very aggressive displacement candle towards the downside, breaking structure in an aggressive fashion, a very quality fashion, creating structure supply in the process, protecting price from coming to this high, you could have some doubts, okay? You could have some doubts because you can see here that that 15-minute OBIF also has that lower time frame inefficiency right here, from this high to this low. Like, you do have a demand POI right there. So you can decide to go for the safer route, not enter on the break here, and wait to see what price does in this environment. So then you go on the higher time frame and you realize, okay, right here we get a very aggressive 15-minute breaker structure where price is completely disrespecting that demand that we initially mapped out, creating 15-minute supply in the process right there in the pivot point. The moment you break that structure so aggressively back to bearish, at the same time, you are also tapping into that demand. So you would like to see what price does in that level. If we close below this demand, then there's simply nothing but liquidity in the lower section, because this is where that true inefficiency is located, and it also represents, because of the overlapping, the total buying pressure of that area. So closing below that demand or showcasing the invalidation of this demand kind of confirms the rotation down towards that sell side liquidity, because we're also breaking structure in the process. So right here, we can see that we tap into it and we create a wick closing above it. If you have a wick, that doesn't mean that that POY gets invalidated. No. It just means that it grabbed the liquidity from the block. And because it was a lower time frame or a more narrow POY, grabbing liquidity is completely normal. But what followed afterwards was that you had these closes below. Guys, we cannot, the moment we see this, we know the demand is failing and we're going to get their rotation down towards the technical target, which is the range low. But entering right there, when you truly see that close below with your stop loss above that high, is not going to be worth it, right? It's not going to be worth it because it's only a 1.6 RR. However, we have created beautiful structure supply in the process of breaking it. So I know that the moment we lose this demand, we're going to get that overall rotation back down. But the RR is not worth it to enter here because it's only 1.6. And I really want to have minimum RRs of around 2. So then my only entry opportunity is going to be if we retrace back into our retest POI, where this created structure supply is our retest POI right there. And because we have an immediate retest, where right after our low, the move up was just an V-shaped move towards that retest POI, I can set a limit order on that supply with my stop loss above the third tap high, targeting the range low. This failure of demand confirms the model for me. And therefore, sometimes waiting for that more obvious break is eliminating any error within the setup itself, because we had 2 demand POIs and waiting for the 10 to 15 minute break here. While breaking that, we immediately eliminated both of those POIs, confirming that this distribution model is actually going to be reversing towards the technical target, because we have nothing but liquidity below now. And because we have an immediate pullback, I am simply setting a limit order on that structure supply. Now, was there a reconfirmation yes, you did have a lower time frame 1 minute breaker structure right here. Okay, you did have a 1 minute lower time frame breaker structure. However, just by waiting for that, in this case, it already eliminates the 3.5 RR towards 2.2. And I'm already confident in the model playing out because all the demand got disrespected and we have such a high probability structure supply POI creation. So I'm just limiting in. Limit order right there, stop loss above the high, done. If you compare this pullback to the pullback we talked about on ETH, you can see the difference. Lots of time in between before mitigating extreme supply, and right here, just an immediate retest going lower. Now from there, price simply made its way overall back down towards that range low, hitting the take profit target. Now, from a trade management standpoint, I want to discuss one more thing. Technically speaking, you have a 15-minute OBIF right there in the upper section of your range. So you couldn't trail your stop loss to this retest low because there was a reason to go higher right there, where the true invalidation remains that Model 1 third tap high. However, you guys know by now that if we want to validate proper OBIFs, we also go to the lower time frame to see what the OBIF on the lower time frame is consisting of. And right here on the lower time frame, we can see that that OBIF was already this 1 minute structure supply that already got mitigated. So that 15-minute OBIF right here was already on a lower time frame that 1 minute breaker structure with the retracement. So technically speaking, there isn't any supply anymore above that high, because on the lower time frame, everything is already mitigated. And whenever that is the case, I am not putting importance on that 15-minute OBIF, because on the lower time frame, that was already mitigated. That is where the true inefficiency was. That delivered the lower high for the lower low, that broke high time frame structure, and this mitigated that created structure supply. Above that, everything is already mitigated. Each lower high for the lower low mitigates supply. Right there, mitigation of this structure supply, push down, and then you have this structure supply right there. Boom, perfect tap, lower high for the lower low. So I don't want to see price come back above that high, because then I would look at this from an extreme supply perspective right here, because everything in there is already mitigated. Now, in this case, I did not end up trailing my stop loss towards that retest high, but I simply did not want to see price come back above it though. And right here, we can also see that we created the 50-minute supply POI in that pivot point, and that is where price ended up coming back for. So if you want to look at it from an extended perspective, you have your 1, 2, 3, and then you have your 4. But you can see that this 4, that extended tap, is way deeper in the range. So therefore, despite me not wanting price to go higher, it's still vulnerable of going higher. When we are retracing or trailing our stop loss towards the retest high on, for example, a ETH, look at where we are placing the stop loss. It's still at the upper extreme. If it was on CRV, it will be deep in this range, which is still riskier. Do you see that difference? This is deep in the range versus the stop loss trailing right there. And this is the second trailing, but we can do that because we swept opposing extreme liquidity. On CRV, the opposing extreme liquidity was all the way down here, which you grabbed at the same time you took the low. So I want you to understand that trailing the stop loss deeper in the range right there, when, you know, you have that massive supply POI, it is riskier, especially when you have a perfect tap of supply, because, and pay close attention, a perfect tap can get taken out, okay? A perfect tap simply means that literally the low of that structure supply is also the high of that retest candle. They're the same. It's a perfect tap. Sometimes not all orders in those situations will get triggered, and price sometimes takes out the perfect tap before going lower in case of a distribution. So be aware, because that's a perfect tap and it's deeper inside of the range itself. I don't want to see price go above it, but I'm not trailing my stop loss to it. And then we can also see we come back for the supply created in that pivot point, and then we sell off. Where the moment we take this extreme liquidity low right there, okay, the moment we take that extreme liquidity low, I am trailing my stop loss to this retest high. Why? Because now that the fact that we swept the opposing extreme liquidity, I don't want to see price reverse back up, because we already took all of the liquidity that we were targeting when we were entering right here. So the moment we break down right there, I'm keeping my stop loss here, because we could go up to take out that perfect tap before going lower. But now that we got the retest POI of supply and we swept opposing extreme liquidity, I don't want to see price reverse prior to taking our hitting our technical target. And that's why in that situation, I will trail to there, but you can see the moment we tapped it, we immediately hit our take profit. But I want you to understand the workflow, right? From the execution process of what we are looking at to, in this case, entering on the limit of the retest, because it was an immediate retest where the break of structure right here indicated that all this demand was going to fill, which is simply the safer bet to take than entering up there. And then right here, we're keeping our stop loss above that third tap because price could take it out because it was a perfect tap and it was deeper in the range. But then the moment we reject of that created supply and we sweep opposing extreme liquidity, now I don't want to see the reversal and I'm trailing it towards that high, with the take profit simply being at the low. Now, on SUI right here, this obviously should be a very famous trade that you should already know, which is the EHP from back in April. And this is going to be a prime example of just looking at this from a stop loss trailing perspective. So the execution here was fairly simple, where you had a very quality break of structure high right there on the 1 hour. And you also created structure demand in the process. Now, I can already tell you, if you're trading a 1 hour break of structure, which is something that I consider, you know, higher time frame, then you can expect a retracement back into a created POI. It's very uncommon for then a 1 hour time frame to just blast up from there. You can already start scaling in right there and add more on the retest, but I was confident in the retest and simply entered right there. And there was also no supply, right? Bit of a big of a position, but on that break of structure right there, there was also not really any supply above us, but you got to be aware of the fact that we were trading an EHP. Like, this was a very high probability setup, okay? So all these low time frame supply POIs, if there is any, right, that supply POI right there, maybe it gives a temporary rejection, right? We can see that structure supply located right there. It can give a temporary rejection, but the moment we confirm that break of structure, man, that's going to rotate back up. Okay, that's going to rotate back up. So you didn't really have any other, in my opinion, proper entry opportunity but that 1 hour market structure high. And you know, when we're selecting the market structure, especially on a higher time frame, in this case, for example, the 15-minute lower high is right here, right? The 15-minute lower high is right there. Why would you enter on the 15-minute break of structure when it is exactly at the 1 hour break? When your market structure highs are that close to each other, just wait for the most safe bet, because in both situations, the RR is going to stay the same, right? The RR is not going to be that big of a difference, while at the same time, in both situations, the RR is going to be high. In this case, well over 5, with a 5.8 RR. So when you have market structure highs that are extremely close together, just wait for the highest time frame to confirm your model, especially if the RR is the same, which it will be if the market structure highs are close together. So when they're close together, wait for the most highest probability break, which is going to be the higher time frame break. So in this case, why use the 15 when it's next to the 1 hour and you're grabbing it, in this case, almost at the same time, okay? So in that case, we're waiting for the 1 hour. And why are we waiting for the 1 hour? Well, because that structure pool isn't valid on the 2. It's valid on the 1. That's why we're using the 1. Okay? So it depends on what the market offers us. So we get that break. It's a high probability break because we create structure demand in the process. And from there, we got that DEEC model, distribution, expansion, extreme demand mitigation before the continuation, right? So the moment we get that break of structure back to bullish and we see our DEEC, we just take this as one break, distribution, extreme demand mitigation, and continuation, okay? The moment you break that structure again right here, above that distribution schematic that created the DEEC, well, you don't want to see price trade below this low again because that's your extreme demand. And if you take that low, there's nothing to protect price from coming to this low. So in the moment you mitigate that extreme demand, if your entry was right here, which is where my entry was, and your stop loss goes below this low, if you're risking $100 on a 4.6% stop loss, if you trill the stop loss to this low right here, you go from 4.6 to 1.8. So your $100 risk goes to like $30 to $40 less, literally in between 30 and 40 on the lower end, while keeping the risk or keeping the profit target the exact same, right? The potential profits, if you hit the technical target, stay the exact same because the position size stays the same. You're just trailing your stop loss to the retest high. And then you break that structure here very convincingly. And guess what? We tap into that supply where it's basically the only supply that's there to protect price from coming towards the range high. But because we are in a confirmed high probability TCT schematic, we can just expect a temporary rejection before eventually making its way back up to the technical target. Now, in the process of mitigating right here, we created this structure demand, which is your extreme demand, because it's the last demand protecting price from coming to that low, which tapped into your previous extreme demand. So you can see a demand chain getting created where this demand bounce created that 45-minute demand bounce, and that 45-minute demand bounce created that 1 hour structure demand POI. Price taps into that structure demand POI and breaks higher. On a lower time frame, already breaking structure back to bullish in this situation. Where if you go to the lower time frame right here, you can see this low, lower high, lower low, massive wick indicating a massive buyback, and then breaking above all these highs, okay? Wicket first, break above it right there. You can extend the mark structure high to those wicks highs, and you will end up getting your break of structure confirmation right there. So the moment you confirm that break of structure, you control that stop loss to that retest low, because that is your extreme demand mitigation. Because if you exceed this low, okay, if you exceed that low, what is there to protect price from coming to this low? Nothing, because this is the last demand remaining protecting price from coming to this low. Therefore, you control your stop loss to the new extreme demand mitigation right there. So we have our entry right here. We have our stop loss initially below the third tap. Then price mitigates extreme demand, so we can trill the stop loss from this low to the retest low right there. And then price breaks structure back to bullish and confirms the higher low for the higher high, and therefore we can now trill the stop loss to the next extreme demand. These two extreme demand POIs are your LPS of the Wyckoff accumulation schematic, because both are extreme demand mitigations after confirming the third tap right there, which is the last point of support, last point of support. These taps are extreme demand, therefore they are part of your Wyckoff schematic, and you control the stop loss below it. So you can see that entering right here, the moment price is right there, still in the discount section, you can already trill the stop loss below this low, and your entry is right below it, meaning you are in a risk-free position. So before price even goes into premium pricing, you are already in a risk-free position. And then you can see price comes up aggressively towards the technical target. Where in this situation, we can talk about extending our take profit target, because this right here, this accumulation schematic came into, ignore the drawings right there, our extreme demand POI following our swing structure, okay? And above the range high, we have nothing but easy to sweep buy side liquidity. So because we are in a POI that can deliver a macro pivot point, and above the range high, there's nothing but easy to sweep buy side liquidity, we can extend our take profit target towards that high right there. Where then if I want to be de-risked, I can either take partial profits here or trill my stop loss to a way where I am risk-free. Where in this situation, price action allowed us to trill the stop loss to that position where we're going to be risk-free. So we're already risk-free by the time we hit the technical target, and therefore I don't need to take a partial profit to de-risk. You can just take 20% profits to actually realize some profits, because this was a pretty big position, and then leave the rest run. Also cover some fees that might have been, taken off your position through funding fee and overall execution fee. We're also right here, if you entered on that breaker structure, you can set a limit order at that structure demand because you have an immediate pullback after breaking structure. Now, if you come for this extreme demand POY right there, then you can see you have a DEEC. So you need to wait for your confirmations again because price took its time pulling back. But if you're simply using the entire structure demand, then that's your immediate pullback right here. This is the immediate pullback, and you can set a limit order right there. And then if you are not positioned yet and you're looking to enter off of this extreme demand, which is the 45-minute demand on a lower time frame, and you see this, which is DEC, you wait for your confirmations again. Okay? So I hope it's starting to become more clear, where in all these scenarios that we talked about, you can see I'm not trailing my stop loss even close to the EQ of the range, right? I'm always staying in those extreme discount sections or extreme premium sections, right? If we right here turn on that 0.75, you can see that all that trade management is going on in the extreme discount right here. CRV, it's mostly going on in the extreme premium until we sweep opposing liquidity. Same for TRX and same for ETH. So focus on those quality breaker structures where we have given you some tips as well to see when you need to ignore structure demand and when you need to focus on structure demand. And then if that demand is there, you can sometimes have even the tap and go situations where even without breaking the higher time frame market structure low, as we showcased on TRX, you can already enter on the failure of the demand. And then despite that, extreme supply mitigations, extreme demand mitigations, the trailing of the stop loss, the partial TPing to de-risk, sweeping that opposing liquidity, not wanting to see price reverse, that is all that you need to know. Okay, that is all that you need to know to trade effectively. And you can see the situations where we are wrong, we are still making money. We're still making money on ETH. We're still making money on TRX. And then CRV played out and SUI also played out. But you can be risk-free so fast. It is amazing. Okay, it is absolutely amazing. Because if you can avoid losing money when you're wrong, it's going to be very easy to make money. Because then when you win, you make money. And when you lose, you're also making money. Or at least not losing money. And that is really going to accelerate your compounding journey.